Hello, everyone. I'm Miles. At the heart of corporate finance, there's a model that's almost impossible to avoid, the capital asset pricing model, which explains something simple yet profound. The expected return of an asset equals the risk-free rate plus compensation for market risk only. Please pay attention to a very important premise. CAPM prices the expected return, not the return that will be realized in the future. In a sufficiently diversified portfolio, individual-specific risk or idiosyncratic risk can be eliminated. For example, incidents unique to a single company, these risks are independent of each other and will offset one another within the portfolio. But there is one type of risk that can't be eliminated no matter how many assets you hold, and that's market or systematic risk. For example, changes in interest rates, these shocks affect all assets at the same time. This is where diversification fails, and it's also the reason why beta exists. Beta doesn't measure volatility. It measures how sensitive an asset is to market movements, which is its exposure to systematic risk. The CAPM only prices in undiversifiable market risk. Company-specific risk doesn't appear in the formula because the model assumes that rational investors have already hedged it to zero through diversification. For an individual stock, what the CAPM actually provides is the minimum required rate of return. In practice, the CAPM is often represented by the security market line, SML, with beta on the horizontal axis and expected return on the vertical axis. The logic for evaluation is very straightforward. If a point is on the line, it's fairly priced. Below the line, it's overvalued. Above the line, it's undervalued. Now let's learn by working through some problems. Suppose the risk-free rate is 3%, the expected market return is 9%, market volatility is 12%, stock A's expected return is 15%, and stock A's volatility is 30%. First question, what is the beta of stock A? Using the formula, 15 equals 3 plus beta times 9 minus 3, so beta equals 2. This means that stock A takes on twice the systematic risk of the market index. For every 1% movement in the market, stock A is expected to move 2% in the same direction. Second question, what is the correlation between stock A and the market? According to a simple statistical formula, the adjusted correlation coefficient equals beta times sigma m divided by sigma A, which is 2 times 0.12 divided by 0.3, equaling 0.8. So stock A is highly correlated with the market, but not perfectly so. High volatility does not necessarily mean high market risk. Third question, what is the idiosyncratic risk of stock A? The total variance of A, sigma A squared, equals 0.09. The variance related to the market is beta times sigma m squared, which is 2 times 0.12 squared, equaling 0.0576. So the idiosyncratic variance equals 0.09 minus 0.0576, which is 0.0324. Then the idiosyncratic risk, that is the standard deviation, is the square root of 0.0324, which equals 0.18. This 18% idiosyncratic volatility does not bring any risk premium because the market won't pay you for risks that you could have diversified away. The professional insight of the CAPM is that the essence of investing is not about chasing returns, but about precisely pricing the risks that you cannot escape through diversification.